What's interesting about it is we engaged in canine counterterrorism. The idea was to train dogs for this particular purpose. We put $3 million to work, have 140 dogs deployed. They've intercepted 200 explosives, and talking about metrics here, and in terms of deterrence, detecting 200 explosives, and we're involved in actual prevention of 3 suicide bombing attacks where there were 2 soldiers that were lost, but there were civilian targets of over 100 people. So in terms of a donor or a philanthropy, you know, I'm pleased as punch. You know, we accomplished our mission to some extent. But then here comes the issue. How long do you sustain, you know, buying dogs and training them for a fairly complex application? Because in a public setting, you have to, dogs are really interesting, those of you that are dog lovers. But you have to train a dog to be able to detect over a full range of explosives where there's in a marketplace or on a bus where there's a lot of noise. In order to establish a sustainable enterprise model for this thing, you have to have donor money to meet that, because you have longer time of training both the handler and dog for the bond. You have a broader range of complexity of things that you have to train on. There's no profitability in that sector, none at all. On the other hand, there's huge profitability in the security business in terms of transport and goods trade. We just, over the last week, engaged in an agreement with a for-profit enterprise, ICTS Europe, which is a French-based company traded on the Neumarkt exchange in Germany, that's actually owned by the Frankfurt airport, if you follow all of that. Okay, so they have a particular expertise in being able to extract air out of cargo shipments and train dogs on a much lower level of complexity, because you just take the air out of the cargo, you take it into a kennel where dogs have been trained to do this, and they can detect the explosive that way. There's no noise, there's no people buying food, or there's no smells from the restaurant, there's no the complexity of people being at bus stops. So it's a much simpler proposition. So in this particular case, we're willing to take in a joint venture operation of a company with a nonprofit. We'll get 25%. We won the first contract with the Port of Haifa and other contracts that are based on that kind of model. So there's a business model. The 25% of our participation will feed back into the nonprofit, which is not profitable in a sense, because you really have to, it's a very expensive type of operation in longer areas. So I tell that story just because I was thinking about it as we were discussing it earlier, as a very narrow focus, canine counterterrorism. I always have to smile when I think about these dogs, but also applied to a specific type of purpose, and why there is the necessity to maybe think outside of the box, or the types of venture that you would want to do to accomplish the nonprofit mission, at the same time seek sources of revenue that would maximize that purpose. Okay, of course you could say, well, we could have brought management in, we could have gotten that contract on our own, we could have bought the technology from the for-profit sector. She wouldn't have had the management people. I know the people that are in operations there, they're interested in dealing with saving lives on bus attacks or civilian attacks. And they're just not set up for that. It would take another 2 or 3 years to get that kind of rollout model. I just bring it, sort of an example of, maybe of things as we were talking in that first panel. And I thought it might be a little bit entertaining. So now I'll get to the more boring stuff. Basically, what are the challenges in growing nonprofit enterprises? It really is, I think, and that example maybe speaks to it, the need for management and financial expertise within the nonprofit world. The problems of metrics, this is a theme that's come up already in the discussion. The needs to Martine mentioned this, to balance mission with money. And the need for capitalization, again, the point that was brought up by Claude, I think in our discussion earlier, is the need for capitalization. Where are you going to get that source of long-term money at a less volatile real interest rate? In terms of increasingly active nonprofit portfolio management, there is, I think, a sea change that's going on. It's really a change between an old approach that was based on lending all funds and holding loans to maturity, managing a portfolio only against catastrophic loss, and no targets for the origination and loan quality. And a new approach where you securitize loans to increase liquidity. You might have a higher deployment of funds, manage those portfolio returns, and try to develop financial products that would meet investor demand. And I think that's the bridge or the challenge that this conference is trying to address. How can, we know in that old Willie's line about, you know, that you rob banks because that's where the money is, the question, we know where the money is in the capital markets, it's in large institutional funds, it's in larger foundations, and the sort of wall that exists between the fiduciary responsibility of the foundations and the program-related investment. We're trying to figure out some mechanism, as John's line about the transport, whatever the biological term was, where, you know, how do you build that transmission belt where you can bridge those things? Now, what are the lessons, I think, from venture capitalists? It's you know, looking at ways to manage risk, to measure performance, to develop close relationships with investments, to invest more over longer periods of time, to develop exit strategies and access to capital. The group that's working at the Nonprofit Finance Fund is looking at this, and again, just as it does in corporate finance, I think in nonprofit corporate or enterprise finance, this question of why capital structure matters is so important. How do we come up with instruments that basically bridge between the endowment and the development of plant or equipment and services? In nonprofit facilities, they're dealing more with the question of plant and of physical facilities, but those are real assets that you can start to leverage off of and maybe have some feedback into program development, and how do you deal with this sort of continuum between the restrictiveness and between the problems of illiquidity, and handle that within the capital structure. These are the same exact sets of problems that you deal with in complex corporate financial structures, right? How you deal with the continuum between equity and debt in some way that's appropriate and allows the management to have flexibility. Because always within corporate finance, what are you dealing with? You're dealing with the problem of how do you have an appropriate capital structure in order to do what? Accomplish a mission, accomplish a corporate strategy. It's strategy and structure do merge in that extent that you can have the business model or the business strategy without having the capital structure that allows it. And this is where financial innovation has been so exciting in I think all of our lives and in our careers, and where biography and history is intersected in financial innovation, is that we've had this enormous period of experimentation. I mean, what was exciting about what happened in the learning curve of the equity market, or as well as in the corporate bond market, was you had all this kind of instrumentation that's appeared over the last 20 or 30 years that now gets refined, and you see it on every term sheet in a venture capital or in a private equity deal. Things that developed in the bond market in terms of PIK instruments or different kinds of subordination and layers of subordination also could be appropriate if applied to the nonprofit sector. And I think especially where facilities needs are, that's a real opportunity. We've been working, Betsy's been working particularly on this issue of preschool financing, both in terms of facilities and programs that speaks to that area. AIDS treatment centers represent another type of application. But wherever you have some potential revenue stream that has a particular social objective, that's important. Now the issue, oops, I forgot. I'm flipping and I'm not flipping the slides here. Okay. Why does capital structure matter? An inappropriate capital structure for a nonprofit, just as for a for-profit, can subvert the ability to achieve those objectives. Capital structures need to be tailored to nonprofit businesses, not their missions. There's a large number of nonprofits that are more capital intensive than smaller startups, and I think if we restrict this just to the venture capital model, then we may be restricting what the applications of investment need are for the nonprofit sector. And then growing nonprofits in a way that requires an increase in fixed to total cost. Now, here I'm going to borrow, and Sherry can speak about this, and Jed Emerson's work, and I think this is just an important